In this presentation, we will work through an example problem related to the Internal Service Fund and government-wide activity. We're going to focus first on the government-wide level because the government-wide level will be on an accrual basis. Then we'll consider the fund level, concentrating on the Internal Service Fund, recalling that an Internal Service Fund is one of the proprietary type funds. Three types of funds: governmental funds, proprietary funds, fiduciary funds. The governmental funds being the largest grouping. The proprietary funds, however, being what the Internal Service Fund is a part of, they use the accrual basis method, similar to what a for-profit accounting typically uses, as opposed to governmental funds using a modified accrual. So, therefore, the Internal Service Fund should be more familiar to the type of accrual method that we might be familiar with for-profit type of accounting. Recall also that the Internal Service Fund is a fund that works with customers in a similar fashion to a for-profit type of organization. However, they're all internal to the organization, internal to the government, as opposed to an enterprise fund typically having those that are going to be external to the government, external to the organization. So, government-wide activities, first item, supplies purchased on account. So we're going to purchase supplies on account. Transaction, then the supplies is going to go up. We're going to have the inventory of supplies, and the other side being vouchers payable. This should look familiar, except for vouchers payable would be replaced with basically accounts payable in normal accrual accounting. So we've got the inventory increasing. It was at the 45,000, increased by the 42,800 to 87,800. Then we have the vouchers payable. It has a credit of 15,600 going up 42,800 to 58,400. That, of course, puts us back in balance here. No effect on what would be similar to basically the income statement from this transaction. What about the fund side of things? Now we're looking at the Internal Service Fund. In the Internal Service Fund, much the same transaction because we are dealing with an accrual type fund here. Therefore, the inventory of supplies is going to be debited. So we're going to debit inventory supplies and credit once again vouchers payable. Transaction looking like this. Inventory of supplies, 45,000 beginning, 42,800 increase to the ending balance of the 87,800. Then we have the increase to vouchers payable. Vouchers payable starting out at the 15,600, increasing in the credit direction to the 58,400. That once again, of course, putting us back in balance. Next, we're going to say, well, what happens at the end of the year, the end of the time period with supplies? Similar process as with a for-profit accrual type basis. We're going to count the supplies at the end. At year end, we're going to say, hey, supplies is at 31,000. That's what it ends at. And this is what the supplies are on the books for. So we got inventory of supplies of the 87,800. It's ending minus 31,000. Difference then 56,000. So the ending supplies, the 87,800 minus what we think it should be at, means we need to bring it down by 58,600 to get to the actual physical count, 31,000. Government-wide activity, again, accrual-based method, similar to what we would expect. So we're going to say, all right, if we post this out, the expense is going to be down here. We're going to record the expense on what would be similar to an income statement type of account. Then we're going to have the inventory of supplies. Inventory of supplies starting at the 87,800 minus the 56,800 credits brings us to the 31,000, which of course is the physical count we came to. That's at the government-wide level. Now let's take a look at the fund level, that being the Internal Service Fund. Very similar process because, once again, we're on an accrual basis as opposed to a modified accrual basis we would be on in other types of funds such as governmental type funds. So we're going to have the same type of transaction here. We're going to have the inventory is going to be a credit to the inventory. It started at 87,800 minus the credit of 56,800 brings us down to 31,000. Then we've got the cost of supplies. So that's going to be cost of supplies was at 0, going up 56,800 to 56,800. Next transaction, back to the government-wide level, we have salaries and wages. Salaries and wages, 119,600. So the transaction for that, we're going to debit expenses for the government-wide level. And so that would be some, wages expense would be what we would expect. And then the credit is going to go to cash. And this is, of course, a simplification of the recording of salaries and wages. We're not going to get into the payroll process here. We're going to post a simplified salaries and wages as an example of the recording of them. And then the other side is going to go to cash. So this would be straightforward accrual type journal entry on more of a cash basis here because cash happened at the same time. So we are on an accrual basis, but paid cash at the same time the expense happened. So cash is going down, 200,000 minus the credit to 80,400. And of course the expense then going up. It was at 56,800 going up by 119,600 to 176,400. Then we're going to go to the fund side of things, that being the internal service fund. Same type of transaction. We're on the same type of accrual method, so we have a similar type of transaction here, increasing the salaries and expense this time, and that's going to be similar to like income statement accounts, expense type of accounts, and credit to cash. So we have the 54,900 minus the 119. We're at overdraw and balance here. Don't let that throw you off. We will have revenue at some point. Then we have back to the government-wide activities. We've got billing from utilities fund. So we're going to say the utilities fund billed the government or the enterprise fund. So billing from the utility fund, which is also part of the government, to the internal service fund, which is going to be our proprietary fund. Transaction here in the government-wide activities, government as a whole activities, we're going to say is the expenses of the 14,500. Cash was paid of 13,600. Then there's a difference of the 900. That's going to go to the internal balances. Now this is a little bit unusual of a transaction, of course, because we're at the government-wide level, and we're talking about two funds that are both basically part of the government, one billing the other. However, one of those funds, a proprietary fund being the utilities fund and enterprise fund, most of the customers of the enterprise fund we can expect would be outside of the government, and most of the customers for the internal service fund, or all of them for an internal service fund, are inside the government. In other words, the utilities fund would be billing people outside of just the government, as well as the internal fund, including the internal service fund. The internal service fund's customers would all be internal. So because we're dealing with an enterprise fund, that's basically the reason we're going to be recording this transaction instead of just ignoring it as basically an inter-fund type of transaction. So we're recording the transaction, a debit to the 14,500 for expenses. We're crediting the cash, 13,600, and then the difference we have to put somewhere, and it's going to go to the internal balances because at the government-wide level, it's an internal balance, and we'll have to deal with this in terms of reconciliations at the end of the process when we reconcile funds to the government-wide activity. So if we take a look at this, then we're going to debit the cash. Cash is 80,400, going down by the 13,600 to 66,800. Then we have the expenses down below. Expenses started at 176,400, going up by 14,500 to 190,900, and then the internal balance is going to be increasing in the credit direction. What about the internal service fund? It's on an accrual basis, so it looks pretty much straightforward what we would expect on an accrual basis. We got the utilities expense being the debit. Now again, utilities expense is someone else it's another fund, it's part of the government, but it's still an expense to the internal service fund, so fairly straightforward expense similar to what we would expect. We have the credit going to the 13,600 cash that was paid. Difference between the two, what is still owed, what would normally go to accounts payable, now going to due to other funds, that being the 900. So we've got the utilities expense, that's going up in the debit direction. Then we've got the cash. Cash, of course, is going down. It's now at a credit balance, so we will have income or cash increasing later, so don't let that throw you off. And then we have the due to other funds acting like an accounts payable account. This is what is owed. However, it's going to go to the due to other funds here, of course, because this is an inter-fund type of transaction. Back to the government-wide activity, we have depreciation on the building and equipment. So at the government-wide level, depreciation, we will have depreciation. We'll record it in essence the same way that we would expect under normal accrual accounting because we're on the accrual system. So we're going to say that we have depreciation on the building. We have the expenses, which would be like depreciation expense. We'll record an expense. On the other side, allowance for depreciation on the building, which would be like accumulated depreciation. So if we record that out, then we have the expense going up like we would expect. We have the allowance on the depreciation going up like we would expect, which makes the book value of the equipment go down. And then if we were to record the other side for that was actually for the building, I should say. If we record the same thing for the equipment, other depreciable asset, then we would say that the expense is going to go up by the 4,600, and then we have the allowance of the 4,600. So same type of transaction. We've got the 32,100 on the equipment, and then we have the accumulated depreciation started at 6,000, goes up 4,600 to 10,600, and of course the expense then increasing as well. What about the fund side of things? Well, we're going to go to the internal service fund. It's an accrual fund. Therefore, we have a similar transaction. We got depreciation expense being the debit, and then the allowance being the credit. So similar type of activity here. Depreciation expense going up in the debit direction. We're crediting the allowance, it going up in the credit direction. The difference between the two is going to be the decrease now in the book value. Then we have the same thing for the equipment, depreciation expense, and the credit to the allowance. So once again, depreciation expense going up in the debit direction, the credit going up in the credit direction. As the credit goes up for the allowance, the book value then goes down. So then we'll go back to the government-wide activity. We have billings, other departments. We have the general fund and the special revenue fund. In other words, we're saying that the internal service fund, a proprietary fund that works for basically internal to the government, is billing the other fund of the general fund and then the special revenue fund, other components of the government. Now the internal service fund, because it's all internal, and now we're billing other funds that are also basically internal. These are governmental funds, the general fund and the special revenue fund. At the government-wide level, the entity as a whole, no transaction here. No, we're not dealing with the enterprise fund, which has customers outside of the organization. This is purely internal service, proprietary fund, but all customers inside the organization, billing other funds that are fully inside governmental funds, the main fund, the general fund, and then the special revenue fund's governmental fund. On the internal service fund side, however, we're going to be recording what would be similar to what we would expect in a for-profit organization. Due from other funds is going to be increasing. That's going to be an accounts receivable type of account, an asset type of account, and then we're going to credit billings to departments. So if we record this out, we have due from other funds. So the due from other funds acting like the receivable at the 4,200, increasing by the 200,300 to the 204,500, and then we have billings to departments. So the billings to departments acting like basically the revenue type of account, all the revenue being internal to the organization. Therefore, billings to other departments is going to be the name of, in essence, the revenue. It going from 0 up by 200,300 to the 200,300. Back to the government-wide activities, we have the amount paid by the funds. So we have the general fund, the special revenue fund. We are imagining they are now paying the internal fund for the billing or invoicing we saw in the prior transaction. So now we're paying off again. Once again, we have the all internal type of government type of activity, the general fund, the special revenue fund being funds within the organization, governmental type funds, the internal service fund being a proprietary type fund, but all the customers of it being internal to the government. Therefore, no activity happening on the government wide level. What's going to happen on the internal service level? We have the amount paid by the funds, the general, we're going to have cash, of course, increasing. So cash is going up. The other side doing what we would expect going to due from other funds, which is similar to the accounts receivable account. So now we have the cash increasing. Here's the cash prior. We now have a debit to it. It's back in a positive number. That's good. And then we have the due from other funds. That's like the receivable account. The 204,500, we are crediting it by the 197,100, bringing it down to the 7,400. Back to the government-wide activity, we have vouchers payable paid. So now we're paying off the vouchers payable, and we're, of course, paying it with cash. Vouchers payable is like accounts payable that we are now paying off. It's on the books as a credit. We're going to debit it to make it go down. We're going to pay it off with cash. So we're going to debit the vouchers payable. We're going to credit cash. That's going to be looking like this. If we post it out, we've got the 66,800 minus the 52,400, bring us down to 14,400. And then the vouchers payable at 58,400 minus the 52,400, bringing us down to 6,000 for the vouchers payable. Recall vouchers payable, similar to accounts payable in a for-profit type of organization. Internal service fund, much the same thing because we are on an accrual basis here as well. So we're going to say that the cash is going to be credited and we're going to debit vouchers payable. Once again, cash this time, if we post out at $118,800 minus the credit, $52,400 bringing us to $66,400. And then the vouchers payable was at $58,400. We are debiting it $52,400, bringing us to the $6,000. And then we're going to go to the internal service fund. We're going to look at the closing process now, closing out the temporary accounts to what would be similar to the equity section. In this case, of course, the net position. So everything in the dark blue area is similar to income statement account, temporary accounts, those accounts that we would close out into equity in a for-profit organization, closing out to net position here. What we're going to do then is we're going to just basically go through all these accounts and do whatever we need to do in order to make it zero. So if this is a credit of the $200,300, we will then debit it. This is going to be a debit of the $56,800. We then are going to credit it. This is a debit of the $119,600. We're going to credit it. This is a debit of the $14,500. We're going to credit it. This is the $5,400 debit. We're going to credit it. And this is the $4,600 debit. We, of course, will credit it. The difference then between the debits and credits, the billable to departments, the revenue, and the expenses is going to be the excess of net billings over costs. And that's going to go into to this account, which we're going to use as basically a clearing account. So that's going to be kind of like what we would think of like the net income type of account that would close out. We're going to put it to a clearing account, a summary account, in a similar fashion to an income summary type account you might be accustomed using with a for-profit organization. In other words, we could close this directly to a net position type of account, which would be similar to retained earnings for a corporation or similar to the capital account for a sole proprietor. But we're going to first put it into a clearing account first, and then we'll make the next transaction closing out from the clearing account. A clearing account, simply one that will go up and then will go back down to zero. Typically starts at zero, goes up for a very short time, and then goes back down, going back to zero after it's served its purpose. So that's what we'll do here. We're going to record this transaction. As we do so, we see that we have the $200,300. It has a credit balance. We debit it, making it go to zero. We got the $56,800 debit. We credit it, making it go to zero. We've got the $119,600. It has a debit. We credit it to make it go to zero. $14,500. It's got a debit. We credit it to make it go to zero, and so on and so forth. And then the difference is going to go to the excess of net billings over costs, the $600, and then we have the debit in the $600. Next step then is to take that $600 debit and move it to where we want it to go, which is the net position unrestricted. So here's the debit balance. We're going to credit it in the excess of net billings over costs. We're going to put the other side in net position unrestricted. So we're going to credit this account, making it go to zero. We're going to put it into net position unrestricted. Has a credit balance. We will debit it, making it go down. Then the next step we're going to take a look at is to reposition between the net position that is net investment in capital assets and net position unrestricted. The way we will do this here is to take a look at the capital assets and compare them to the equity section. So in other words, we're thinking about these long-term assets. And the reason we are is we want to think about of the assets minus the liabilities of the assets, or the net assets or the net position that we have, which ones are going to be current and those that we can then use and which are not. So to consider this, let's add these up. We're going to say we have the $25,500 plus the $124,500 minus the $13,300 plus the $32,100 minus the $10,600. That gives us the $156,200. Now we're going to compare that, and we're going to make basically this number equal to it, the net position number. So I'm going to subtract minus the $166,200. And that means we need an adjustment of $10,000 to get down to what would be equivalent to what the amount in the basically property, plant, and equipment, the capital assets would be. So in other words, if we record this, this will be our transaction: net position, net investment in capital assets debit, and then we credit net position unrestricted. If we do so, then this $166,200 is going to be debited, making it go down to $156,200. And the net position unrestricted is the $87,900 minus the $10,000, bringing us down to, or up to, the $97,000 900. Now we'll recall that the net position, like the equity section, is equivalent to the assets minus the liabilities. So it's kind of, you can think of it as the net assets. The net assets are something that we expect to be, people are going to want to spend, possibly. They might be planning to spend the net assets. We want to be able to tell them specifically within the net assets section that, hey, these net assets are related to capital assets. You can't really spend that portion of it because if you think about it, the land, 25,500 plus the 124,500 minus the accumulated depreciation, 15,300 plus the 32,100 machinery and equipment minus the related accumulated depreciation, 10,600 is 156,200. So of these two numbers, the net position, assets minus liabilities, 156,200 represents capital assets, long-term assets that we can't really spend anytime soon. So that's one reason we want to basically break this out and be able to represent within what would be similar to the equity section, or in this case, net position section, the amount representing capital assets. Next, we'll take a look at the financial statements, including the statement of revenue, expenses, and changes in fund net position for the internal service fund. This is going to be similar to an income statement type process. We'll put this together relatively quickly here. We're looking at those accounts below what would be similar to the equity accounts, the dark blue accounts, the temporary accounts, starting with billings to departments. You'll recall that's similar to income because we're an internal service fund and therefore we're billing internal departments. That's going to be on the outside. Then we're going to have the operating expenses, including all of the expenses here. We have the cost of supplies, salaries and wages, utilities, and the depreciation, adding up to the total operating expenses on the outside, subtracting these two outs, the billings to departments and the total operating expenses. Then we have a net income or loss, in this case, of the 600. Then we're going to tie this out to what would be similar to the equity section. So we're going to take the beginning equity section. This is going to be similar to like retained earnings for a corporation or the capital account for a sole proprietor. That's going to be the 166,200 plus the 88,500 or the 254,700. And if we take the 600 minus that number, we then get to the net position at the end, the 254,100. Then let's take a look at the statement of net position, similar to the income statement, just going straight down top to bottom, starting with the assets. All the assets, we start with current assets because we are breaking out, remember, between current and long-term type of assets because we are on an accrual basis. Current assets including cash, due from other funds, and inventory of supplies. That gives us the total current assets. Then we have the capital assets like the property, plants, and equipment type assets, land, it not being depreciated, building, however, having depreciation. Therefore, we have the building on the books, 124,500 minus the accumulated depreciation or allowance for depreciation, 15,300, giving us the net book value, 109,200. Then we have the machinery and equipment, 32,100 less the allowance for depreciation, 10,600, giving us the book value, 21,500. Then we have the total capital assets, that of course being the outer column, 25,500, the 109,200, the 21,500, that's the 156,200. Okay, and then we're going to have the total assets, which will be the 104,800 plus the 156,200, that's the 261,000. Then we got the liabilities, including the voucher payable, similar to accounts payable, and due to others, that a total of 6,900. And then we've got the net investment in total capital assets and the net position amounts of the 254,100. Of course, if we take then the assets, 261,000 minus the liabilities of 69, we get to the 254,100. Or in other words, if we took the 24100 plus the 69 we get to, let's do that one more time. If we took the 254,100 plus the 69, we get to the 261,000 in total assets equaling liabilities and net position.